It's not going to take 7 years this time. It might be more like 7 months. And the reason is twofold. Number one, we're more leveraged and the stock market is more bubbly. And so the whole thing's more vulnerable. Number two, the market has seen this movie before. Like, hey, we watched this play out. We know it doesn't work. And the Fed balks. Now, so if the Fed suddenly slams on the brakes, says we're not going to keep raising rates along the lines I projected earlier, okay, that might give the stock market a boost. And you can't assume that won't happen. You got to watch for that. But I would expect that things would have to get pretty ugly in all events before the Fed got that message. On the other hand, if Powell gets confirmed and feels like it's his last term and here's his chance to be Paul Volcker and he's just going to keep raising rates, he said, my job is to get inflation under control. The rest of you people, you're responsible for fiscal policy and tax policy and spending and shutting down the Keystone Pipeline.
Welfare.
And all that. That's on you, not me. My job is to get rid of inflation. If he does that, and he might, you're looking at a recession, kind of looks like the global financial crisis, and hope it doesn't. And there's a difference between extreme recession and financial crises. They're two different things, but they can happen at the same time as did happen in 2008.
In this video, Jim Rickards talks about the challenges and potential risks faced by the Federal Reserve in managing the economy. The central theme revolves around the delicate balance that the Fed must strike between preventing a stock market crash and avoiding a severe recession. Jim raises concerns about the Fed's ability to have perfect information, citing flawed models and the possibility of being behind the curve in recognizing economic challenges. The distinction between a recession and a financial crisis is highlighted, with historical examples used to illustrate that these two phenomena can occur independently. Jim Rickards emphasizes the difficulty the Fed might face in choosing between preventing a financial crisis or accepting a recession as a trade-off. The reference to Paul Volcker's actions in the 1980s adds historical context, showcasing a deliberate choice to induce a severe recession for the purpose of combating inflation. However, Jim Rickards notes that the current economic landscape is more intricate, with additional considerations such as systemic risks and the potential for a recession triggering a financial crisis. In conclusion, Jim Rickards underscores the complex decisions the Federal Reserve must make, acknowledging the uncertainties and trade-offs inherent in steering the economy and avoiding undesirable outcomes. Before we get into the video, can you help me to give that like button a little touch? Alright, let's get into it.
Would the Fed back off if it became apparent that they were going to cause a stock market crash, a disorderly collapse, and a severe recession? The answer is almost certainly yes, but the problem is it might happen anyway. In other words, they might have gone too far, and this almost happened in 2018, and that was my point. It was that by the time they realized their mistake, it might already be too late. So that's one danger, which if they had perfect information, oh gee, we went too far, gee, we couldn't pull this off, we need to back off. They might back off exactly as you described, but they don't have perfect information. They have flawed models. They tend not to look at history, and they could
behind the curve.
They could crash the car before they knew it was out of control. It's like slamming on the brakes on ice. You can slam on the brakes, but you're going to go for a long time before the car stops. So that's one problem. The second problem is you have to separate, as I said, recession, even severe recessions, from financial crises. In 1998, we had a financial crisis, but no recession. In 1994, we had a financial crisis, no recession. In 2020, we had a severe recession, no financial crisis. That was not a financial crisis. In 2001, we had the NASDAQ collapsed 80%, but there was only a very mild recession, and that was not a financial crisis. So the Fed might say, and again, might, because who knows, but they might say, well, of course we don't want a financial crisis. Now, to your point, Nick, nobody wants that, and they do get out of control. But we're not worried about that. You know, we learned our lesson in 2008. We had Dodd-Frank. And I had this discussion with James Gorman, the CEO of Morgan Stanley. I briefed their board, and they gave me a lot of pushback. They said, "Well, you don't understand, Jim. We have more capital and greater liquidity and less leverage and better credit." And I granted. I said, "You're absolutely right." I said, "Nice job. You're a stronger bank now than you were then." But in a financial crisis, it doesn't matter. The problem is systemic. In other words, as an individual bank, you may be better off. But if the whole system's collapsing, you can't necessarily withstand that. So they don't want that. But what if they said to themselves, you know what, we don't want a financial crisis, but we don't think that's going to happen. But maybe we'll just have to bear a recession. Volcker knew what he was doing. Volcker knew that there was going to be a recession. And the recession of 1981-82 that he caused was at the time the worst since the Great Depression. Now, we've surpassed that twice since then, 2008 and 2020, although it's hard to know what 2020 was. I mean, down 36% in 2 months and up 38% the next 2 months. I mean, what is that? But at least in technical terms, we've had two worse recessions, 2008 and 2020 since then. But at the time, and I lived through that, I was around, that was the worst recession. But Volcker knew that would happen. He said, that's the price we have to pay to break the back of inflation. And he did. And by 1986, inflation was like 2% or 1.8%. Now, there was far less worry about financial crises at the time. Because remember, this was before the repeal of Glass-Steagall. You know, commercial banks, no one really cared about investment banks. They could fail. So what? They cared about the commercial banks, and they had a pretty good handle on that. So they weren't worried about financial crisis. But today you would be for the reasons we mentioned. So there are two possible major blunders here, but again, don't underestimate the Fed's ability to do both. One is that they could decide they don't want a recession, but not know until it was too late. They just tighten into it, don't know it until it's too late, and then the damage is done. The other one is they could sign up for a recession, say, yeah, sorry, but that's the price of getting inflation under control, and trigger a financial crisis that nobody wants but could happen anyway. So, you know, it's kind of so and Charybdis, take your pick. Severe recession, but we know it's coming. Recession that causes a financial crisis that we didn't want, or just let the inflation rip. What's the good outcome there? What's the good one?
Yeah.
But I think those are the three choices. I think you're right.
In the face of these complexities, our discussion leaves us with three potential scenarios: the risk of unwittingly tightening into a recession, the prospect of accepting a recession for inflation control, or the challenging choice of allowing inflation to run rampant. The Federal Reserve stands at a crossroads, and the decisions they make in the coming months may well shape the economic landscape for years to come. As we conclude our exploration, it becomes clear that the path ahead is fraught with challenges and decision-making. The balancing act between preventing a stock market crash and avoiding an unintentional recession places the Federal Reserve in a formidable position. The lessons from 2018 serve as a stark reminder that perfect information eludes them, and the consequences of their decisions may only become apparent once it's too late to correct. The historical perspective sheds light on the dual nature of economic downturns, where financial crises and recessions don't always go hand in hand. Drawing parallels to Paul Volcker's bold strategy in the 1980s, we ponder whether the Fed might consider accepting a recession as a necessary sacrifice for taming inflation.
Debt can be managed if you have enough growth, but we don't have enough growth anywhere in the world. The U.S. is growing the strongest, but only about 2%. Europe is growing around 1%, barely. Japan has actually been in and out of recession multiple times. China has a higher growth rate, but they actually manipulate a lot of their data. A lot of their growth is from investment, which is wasted. So if you discount for that, their growth is a lot lower. So the whole world has too much debt, not enough growth. That's the problem that the financial elites are trying to solve. Well, debt is not automatically a problem, subject to several conditions. If you borrow money and you put it to productive use so that the profit from the investment is more than enough to pay the interest, and if you're growing fast enough to afford the debt, then it's manageable. But that's not the situation in the world today. The problem in the world today is that a lot of debt is being incurred, the money's being wasted, and we don't have enough growth to pay off the debt. So this mountain of debt is getting larger and larger relative to the productive capacity of the economy. So again, if you can afford the debt and put it to good use, that's one thing, but that's not the world today. We're wasting the money and we cannot afford to pay it back. Well, once you're in the situation we described, there are only three ways out. One is growth, we talked about, but we don't have the growth. The other one is outright default, just don't pay it, which would cause a global financial catastrophe. We all know that. But as long as you can print the money, there's no reason to default. The third way out, and the one that the elites prefer, this is the global elite secret plan, is inflation. They have to have inflation. Basically make the currency worthless. So I can say, if I owe you $1 trillion, Simone, here's your $1 trillion. Good luck buying a loaf of bread because I printed the money and it's not worth very much. That's the secret plan. The question is, how do you do it? So we said that the elite plan is to have inflation. They have to have inflation. But the question is, how do you get inflation? I call this the problem of Jaggernomics in honor of Mick Jagger, member of the Rolling Stones band. They had a song, "You Can't Always Get What You Want." So the problem today is central banks want inflation, but they can't get it by money printing, forward guidance, other market manipulations. They have not been able to get the inflation they want. So now the global elites are saying, okay, monetary policy will not solve the problem. Monetary policy alone will not give us the inflation we want. So we have to try something else. And the question is, what is the something else? There are a number of plans. One of them is negative interest rates. And the idea is, so normally you put your money in the bank and you earn some interest. The bank pays you money. With negative interest rates, you put your money in the bank and they take your money away. Now this is designed to get you to spend it. The idea is, well, if Simone knows I'm going to take her money away, she'll go spend it rather than sit there and let it be taken away. But this is a typical financial elite plan. They don't understand real world behavior. They don't understand how people actually think. What people do is they say, well, if you're going to have a negative interest rate, you're going to take my money away, I have to save more in order to meet my goals, whether it's buy a house or pay for my children's education. So people actually end up saving more. They also say to themselves, what signal are the central banks sending with negative interest rates? They must be worried about deflation. Deflation means lower prices, so people say, well, I'm not going to spend it, I'll wait till prices drop and then buy something later at a cheaper price. So negative interest rates are designed to encourage spending, but they actually have the opposite effect. They encourage more savings and less spending. Very typical of these elite plans. They dream up these ideas, but they don't work in the real world. The second thing they're thinking about doing is called helicopter money. And this goes back to a speech that Milton Friedman gave decades ago. And he said, well, look, central banks can always cause inflation. All they have to do is print money, push it out of helicopters. People will run around, scoop it up, and take the money and spend it. But the question is, how do they actually do it? What do they mean by helicopter money? What they mean is you're combining fiscal policy and monetary policy. So on the fiscal side, governments will spend the money. See, the problem is people don't want to spend. They're fearful. They want to save more, spend less, de-lever their balance sheets, not take as much risk. But government's very good at spending money. You would run larger deficits, have more government spending. Could be on whatever you want. It doesn't matter as long as you spend the money. It could be infrastructure, it could be defense, could be social welfare programs, benefits, medical, etc. Whatever it is. The government spends the money. This means larger deficits. How do you cover the deficits? Government borrowing. How do you issue the debt? The central banks print the money and buy the debt. So basically you have the government and the central bank working together to spend more money and then issue more debt and then print the money to buy the debt. So that's what helicopter money is. This is very likely to be inflationary. There are two other ways that the elites are trying to get inflation, if they have to. One would be through the IMF to issue SDRs, which are special drawing rights. I think in French it's DTS. It's a special drawing right from the IMF. This is money from thin air. This is world money because the European Central Bank can print euros. The Federal Reserve can print dollars. Well, the IMF, the International Monetary Fund, they can print SDRs. They can print their own money, hand it out to their members, and then that money can be spent. So that's another way to do it. And then the fourth way to do it, and this is the last resort, not something they want to do, would be to arbitrarily raise the price of gold. So a central bank could come along and say, you know what, as of today, the price of gold is going to be 5,000 euros per ounce. Just declare that. And then you would say, if you think that price is too high, sell us your gold, we'll buy it, we'll print money and buy it. If you think it's too low, come and get it, we'll sell you the gold. And in Europe, Germany and France and Italy and the European Central Bank have a lot of gold. The United States has 8,000 tons of gold. Europe has over 10,000 tons of gold. So if you say, okay, so the price of gold is 5,000 euros, I'm a buyer at 49.95, I'm a seller at 50.50. So you make a market, I'll use actual government gold to back up the market, then gold is 5,000 euros per ounce. Now the point is, nothing happens in isolation. If you have 5,000 euro per ounce gold, it also means the price of oil, the price of copper, wheat, steel, cotton, everything else, wages would go up as well. So it would cause inflation. So you basically have four ways to get inflation: negative interest rates, helicopter money, SDRs, and raising the price of gold. They may go to all four. They may try them one at a time and end up with a higher price of gold. But here's the thing, Simone. All of them mean a higher price of gold. It doesn't matter how you get the inflation. Once the inflation comes, the price of gold is going to go up. Just to kind of summarize and wrap up everything we've said, there's too much debt, not enough growth. The solution is inflation. But the question, the problem the world is facing, how do you get the inflation? And we've outlined the ways. The first is negative interest rates, which means a war on cash. Second is helicopter money. The third are the special drawing rights, just world money. And of course, the fourth way is to raise the price of gold. That will be the last resort, but those are the four ways. All of them are inflationary. All of them mean a higher price for gold. Well, that's right, Simone. We talked about this global elite plan for world inflation and how they're going to get there. We've gone through that in a lot of detail. But that's just part of an even bigger plan. What they want is world inflation, world money, world taxation, and a world central bank, which will be the IMF. So the IMF will be the central bank of the world issuing money. That'll make dollars and euros much less valuable because the SDR will be the new global currency at that point, of course, which is highly inflationary, which we talked about. And then finally, who controls the IMF, the central bank of the world? They have an executive committee, but it's really the G20. So I think of the G20, which are the largest developed economies and emerging markets such as Russia and China and Brazil and a few others. The G20 are the board of directors for world control. You know, Simone, it may be too late for small savers to stop this elite plan. They may not be able to do anything about it, but it's not too late for them to protect their own net worth. They can do that. My first recommendation is investing 10% of your investable assets in gold, physical gold. So not gold futures or gold options or other gold paper products, as we call them, but actual physical gold kept in non-bank storage in a safe place. Not 50%, not 100%. You should never go all in, but I recommend 10%. That's enough to preserve wealth if everything else falls apart. For the rest of your portfolio, there are a number of things you can do. I actually recommend some cash. You might not want cash for long, but temporarily it'll reduce volatility, and you can use the cash to buy more gold when the time comes. And then also some private investments and in growth areas, technology, natural resources, hard assets. So there is a model portfolio that we recommend, but it starts with 10% gold. Vladimir Putin has a 6,000-member cyber brigade. They work day and night to penetrate Western financial systems in Europe and the United States. They can completely wipe out your digital wealth. It would be gone and you would never know it.
This banking crisis is far from over. All the dominoes never fall at once. They fall sequentially, and sometimes there are time gaps between them, and everyone says, oh, all good. It's not all good. You have to look behind the curtain of the international monetary system, understand what's actually going on. These failures are symptoms more so than the real problem. The real problem has to do with tight money. Interest rates are 5%. They're going to be, 5.25%. But that is a year or just over a year ago, March 2022, they were zero. So you go from 0 to 5.25% in about 1 year. That's extraordinary. I mean, people remember Paul Volcker raised interest rates to 20%, and he did. But that played out over a couple of years. This is 5% in 1 year, and the Fed's not done. I mean, they're saying we're going to think about it. We want to look at more data, but they have not said we're done. This whole pivot narrative has been wrong for a year, and it's wrong now.
This banking crisis is far from over. What a great news to start our day, eh? Jim Rickards said that the banks will never fail all at once. You have to be cognizant of the situation, like the market condition, public confidence, and of course, the interest rates. One of the easiest indicators of a healthy economy is the interest rates. If the economy is in a red-hot inflation, then the Fed has to raise interest rates in order to cool down spending and encourage the public to save money because they will earn more interest with their bank. The Fed has raised interest rates from 0.5% to 5.33% in just 1 year, the fastest and highest in the history of Federal Reserve. But the inflation hasn't come down yet, so the Fed has to keep raising the interest rates. This whole pivot narrative has been wrong for over a year, Jim Rickards said. The Fed will never do a pivot. Pivot means stop raising the interest rate and instead start cutting it down. The Fed will keep raising the interest rates until they bring inflation down. A good bank risk manager will think, the Fed is raising the interest rates, it means the bond price is going down. I think I should sell my bonds so that all of my bank deposits will not lose any value because of the bond prices going down. But instead these bank managers do the opposite, so people will take their money from the bank. Jim Rickards said it will be worse than the 2008 global financial crisis. Let's hear more from Jim.
So we have tight money, we have underwater bonds, we have bank management who don't know the first thing about risk management. If you knew anything about risk management, once the Fed said, "Hey, we're gonna raise rates until we kill inflation," and that is what they said. Jay Powell gave 8 speeches between the summer of 2022 and recently, and he said that every single time. Well, if you're a bank risk manager and you hear that, you're like, "Huh, I got bonds. Interest rates go up, bond prices go down. I understand they're unrealized losses unless I sell them if they're in what's called a hold to maturity account, but they're still losses, and it still destroys confidence." Now, bank bonds today, you don't have to line up around the corner in the rain, with your hat on, waiting to see the teller. You can just do it with your iPhone, and to the tune of you can move $1 billion with your iPhone if with the right accounts and passwords and all that. And so that's what happens. So the bank bonds are instantaneous. And they're far from over. So yes, a little, kind of in a quiet period, but there'll be more. And the good analog, Matt, is the 2008 financial crisis. Everyone remembers, September 15th, 2008, midnight on a Sunday, Lehman Brothers files for bankruptcy, and that's true. But that started in the spring of 2007. When HSBC reported disappointing earnings based on mortgage losses, and then came to a head in August. 2 Bear Stearns hedge funds failed. There were high yield mortgage funds. At the end of July, August, the Fed raised the discount rate. It took a full year, another 13 months, to get to Lehman Brothers. And what happened along the way? Bear Stearns in March 2008. Fannie Mae went bankrupt in June 2008. Freddie Mac bankrupt in June 2008. Congress bailed out the system in August 2008, and then Lehman Brothers. So that took a year and a half, and there are a lot of crises like that. So we're in falling dominoes. It's not over. It'll get a lot worse, and people should prepare for that. But as usual, they don't. People are very complacent. Wall Street says it's all good, and people believe it, but they shouldn't.
Jim Rickards has explained the current predicament that we're in. It's the tight money policy because of the high interest rates. This situation is very similar to what we had back in 2008 when Bear Stearns, Fannie Mae, and Freddie Mac got bankrupt because the Fed is raising the interest rates. It's similar to what we have now, where the interest rates is very high and the banks are hesitant to lend money to anybody. So, how the situation will end? Spoiler alert, it's far worse than you thought.
Well, it either ends when, it can end 2 ways. One is something like 2008, but worse, just a generalized global financial crisis where everybody's getting the money out of every bank, either buying treasury bills. Treasury bills at a brokerage firm are pretty safe because it's not about the brokerage firm. Brokerage firms fail all the time, but they have to segregate house funds, proprietary funds, and customer funds. Money market funds, same thing, in the sense that in 2008, the government proved that they're willing to bail out money market funds. And they did, guaranteed every money market fund in the country. So the best safe haven is gold. I say physical gold. Bullion, coins or bars, and silver. It's not digital. You can't hack it. You can't steal it, and you can't freeze it. They just put it in a safe place. So Americans don't really get gold. They don't really understand it. So yeah, I think it's just going to be a question of frog hopping from lily pad to lily pad, looking for a safe place. The other scenario is that the government just throws in the towel and says, okay, all deposits are guaranteed in unlimited amounts. And I knew people who were trying to get $8 billion out of Silicon Valley Bank on that. They sent the wire instructions on Thursday night. One guy I talked to said, hey, Jim, from Thursday night to Sunday, we didn't know where the money was. We sent the wire instructions. We were trying to get it out, but we didn't know what the outcome was going to be, whether it was short or not, wire sent or not. And then Sunday night, the Fed and the FDIC came out and said, all good. We're going to, business as usual, open Monday, and it's all good. And he said the money went through, but that was what people were facing, and they'll continue to face. The banks you mentioned, I don't know what their deposit flows are right now, but my guess is they're shrinking fast. People are getting their money out, and so you might just have to give a generalized blanket deposit insurance protection. and that would stop bank runs in theory. But then now you basically nationalize the U.S. banking system. You look like Argentina. So there are no, I guess the way to put it, Matt, there are no good outcomes. Either there's a catastrophe worse than 2008 that starts to look like 1931, 32, or the government offers so much protection that they've de facto nationalized the banking system. But the one thing I've noticed is that each crisis gets bigger than the one before, and each bailout is bigger than the one before. And the question I'm asking as an analyst is, are we at the point where the crises are so big, it's bigger than the Fed? In other words, we're not really talking about bailing out a bank or a sector. People lose confidence in the dollar itself. And we do seem to be heading in that direction.
Jim Rickards said the crisis will get bigger than the one before. In 1999, Wall Street bailed out the market, and in 2008 the Fed bailed out Wall Street, and now, who will bail out the Fed? Jim proposed the idea of the dollar collapse. People often misunderstand the concept of the end of the dollar as the global reserve currency and as a payment currency. Let's listen to what Jim Rickards has to say.
But I find there's a lot of confusion on the topic. And the confusion comes from the fact that everyone talks about the end of the dollar, the dollar is going away as a global reserve currency, etc. But people don't distinguish between the role of the dollar as a payment currency and the role of the dollar as a reserve currency. And those are two very different things. There's some linkages. But payment currency, basically, if I want to buy goods and services from you, and I tender some form of currency and you're willing to accept it, and you're confident someone else will accept it from you, that's a good payment currency. It could be dollars, it could be euros or yuan, or it could be Russian rubles or Brazilian rice or anything, as long as people are willing to accept it, have confidence in it. A reserve currency is a very different thing. First of all, we don't really have reserve currencies. You go to the People's Bank of China, they don't have $100 bills stacked up in the basement. What they own are U.S. Treasury securities, which are digital, by the way. The last paper Treasury security was issued, I think, around 1979. So what they have are actually securities. So when people say reserve currency, what they really mean is securities that hold your reserves denominated in a currency. So, of course, Treasury securities are denominated in dollars, but they don't have actual dollars, in a bank account or a physical form. They own securities. Now, as far as the payment currency is concerned, that's relatively easy to displace. This is what all the news is about. So the BRICS, that's Brazil, Russia, India, China, South Africa, they're working on a new payment currency, and that we're likely to see a big rollout of that this coming August. Don't know exactly what it'll be. They're working behind the scenes. It could be commodity backed. It could be gold backed. I'm not predicting that, but that's certainly one of the possibilities that we need to look at. But there is one thing that could knock the dollar off, which is gold. Gold is just gold. If you have physical gold, bullion or coins, you don't need all that other stuff. You just put it in a safe place and guard it, like Fort Knox or whatever the Russians and Chinese have their equivalents, and just sit on it. It's not digital. You can't hack it. You can't freeze it, etc. So if someone said, so the idea of the dollar losing ground as a payment currency is completely plausible. It'll happen in stages, and it's happening already. The idea of the dollar losing its role as a reserve currency, it's not going to lose it to another currency, but it could lose it to gold. The debt's not going up at 2% or 3%. The debt's going up 8, 9, 10% or more. The U.S. had a $1 trillion baseline budget deficit, $1 trillion per year deficit for fiscal 2020 pre-pandemic. The Congress threw $3 trillion of emergency aid on top of that. And I'm not even criticizing all those programs. I mean, the payroll protection plan loans, the extended unemployment benefits, the increased unemployment benefits. Imagine where we'd be if we hadn't done that. But that aside, debt is debt. They piled $3 trillion on top. Now, this is going to take the U.S. debt to GDP ratio up to 135%. It was 106% when Donald Trump was sworn in. It's close to 130% today. Because remember, you got two things going on. It's a debt to GDP. So debt's your numerator and GDP is your denominator, right? Well, what happened? Well, the denominator shrank. This got smaller and this got bigger. So what happens to the ratio? It blows up. So now it's 135%. If you get the laws of economics right, which is not easy because most economists don't, but if you get them right, it's really a reflection of human nature. I mean, what is an economy other than all the people in the economy starting businesses, buying, selling, traveling, providing goods and services, et cetera? So human nature doesn't change, or at least it hasn't changed much in the last 100,000 years. So the fundamental laws of economics don't change either, but circumstances change, facts change, and that's important. Now, to answer your question, Curry, you're right. There is a school of thought, a growing one, an influential one, that the debt doesn't matter. It's like, well, wait a second. So what? So the debt to GDP ratio went to 135%, which it did. Who cares? Well, what's wrong with it? 180%. We got issues. We got problems. Print up the money and monetize the debt and spend it and keep going. What is the problem? This comes under the banner of something called modern monetary theory, MMT. It's flawed. It's wrong, but it's got its followers, and those followers are now in the White House because one of the things Joe Biden had to do to get elected was to make peace with the Bernie Sanders wing of the Democratic Party. They take the view that if the Treasury didn't spend the money, how would anybody make any money? That's ridiculous, but that's what they say. They say, hey, when the Treasury spends money, what do? Well, they build aircraft. They have benefit programs. They have government contracts. They do whatever they do. But when the Treasury gives you the money, you take the money and you spend it on somebody else, goods and services, go out to dinner, have subcontractors, whatever it might be. That's the real source of money. They also take the Treasury and the Fed and they merge them. Now, that's not legally the case. The Treasury and the Fed are separate institutions. The Treasury is just part of the executive branch, and the Fed is an independent agency. And the Federal Reserve banks are actually privately owned. That a lot of people know. Some people know that, some people don't. But the Federal Reserve banks are privately owned by banks in the districts, or Citibank, Bank of America, et cetera. So they're completely separate. But the theorists ignore that and say no. The Treasury needs to spend money because that's how the economy grows, and the Fed can monetize the debt. So you spend the money you don't have, you borrow to cover it, you issue bonds to cover the borrowing, and if the market wants to buy the bonds, fine. But if not, the Fed can buy them and put them away on the balance sheet, wait 30 years and collect the money. What's the problem? Who cares about the debt to GDP ratio? It's kind of a statistical abstract, but why should that stand in the way of using money to solve our problems, which are free healthcare, free childcare, free tuition, forgiveness of student loans? That's a 1.6 trillion dollar ticket, by the way. And look, everyday readers and investors, there's no reason they should know all this stuff. This is total inside baseball. You have to be a geek like me to kind of keep up with it, but it's all coming. But what that means is we're going to test the Rogoff-Reinhardt thesis. Now, let me just take a minute to explain that. Up to a certain debt to GDP ratio, there is a Keynesian multiplier greater than 1. So the classic example is the UK was in a depression before the rest of the world. They had been hit pretty hard before the Wall Street crash. People aren't spending, they're saving. It's the liquidity trap. So if you get money, you pay down debt. When you don't have any debt, you put it in the bank. Whatever you do, you don't spend it. You hoard cash. Or people were buying gold. They were accused of hoarding gold, etc. But what they weren't doing was spending. And there was a lack of aggregate demand, and the banks were not lending. So Keynes said, well, if everyday people won't do it, the government must. The government can borrow. The government can spend. And what they discovered was that if you borrow $1 and spend $1, you can get $1.50 of GDP. Now, there's a separate debate as to whether that's actually incremental or whether you're just pulling growth forward. But so what? Even if you are pulling growth forward, maybe that's what you need to do when you're in a liquidity trap. But there's a problem. He called it the general theory of employment, interest, and money. But it was actually a special theory. I think he had a little Einstein in me because of the general theory of relativity. But it's actually a special theory, which means it's a theory that works in a set of circumstances, a set of conditions. The conditions where it works are you're either in a recession or just coming out of one. You have excess capacity and labor and industrial capacity, and you have very little debt. In those circumstances, you can borrow $1, spend $1, and get more than $1 GDP. The problem is that extra GDP you get for the borrow and spend, it goes down as the debt to GDP ratio goes up. What Reinhardt and Rogoff discovered is that at 90%, you go through the looking glass. Your payoff is now less than $1. You borrow $1, you spend $1, and you only get 90 cents of GDP or 95 cents, etc. So now, not only are you not getting your dollar's worth for the borrowed dollar or something more, which you did at lower levels, you're getting less than $1. So now what's happening? You're borrowing $1, you're spending $1, you're not getting $1 of GDP, but you are getting $1 of debt, which means your debt to GDP ratio is going up and the 90% is getting worse. And I just mentioned the United States is at 135%. So here are your two competing schools. There's the Keynesian multiplier and creating aggregate demand with government debt, and the Reinhardt-Rogoff, more than a thesis, I would say powerful evidence that beyond 90%, it doesn't work. It goes under less than one, on the one hand. And my friend Stephanie Kelton and Bernie Sanders and Kamala Harris and the modern monetary theorists who say, no, it's all good. How could you get growth if you didn't spend money through the government? These theories don't agree at all. We're going to find out which ones work. I'll give away the answer, which is that Reinhardt and Rogoff have it right. Keynes had it right up to a point. Reinhardt and Rogoff discovered that critical threshold, that whether you want to call it tipping point or phase transition, or which physicists call it or whatever. The modern monetary theorists think the opposite, and we're going to find out. But what it means if Reinhardt and Rogoff are right, and I'm right, and Keynes was right, the more you borrow, it's actually a headwind to growth. Now you get just as up to the threshold, you got more and more and more. Oh, sorry, at a low level, you got more, but then it went down. But it's like any diminishing marginal return. You know, the curve starts very steeply, you get a lot of payoff, then it flattens out, then it goes down, but it's still positive. But at some point, it goes below the zero line and your marginal return is negative. And that's where we are. So we're in a depression right now. It will last for a long period of time. But a lot of people get confused, and one can understand why, about the difference between a recession and a depression.
Yeah.
Most mainstream economists, they don't like what I call the D word. They don't talk about depressions. They talk about recession. So a recession is conventionally defined as 2 or more consecutive quarters of declining GDP. And this would be the first back-to-back recession since 1980, 1981. So you have a recession, you come out of it, and then you go right back down into recession. So that's technical recessions. Depressions are different. And a lot of people think, well, if a recession is 2 quarters of declining GDP and a depression is worse, well, a depression must mean 10 quarters of declining GDP, as if it's a really long recession. And that's not the definition. The depression means depressed growth. Growth is depressed relative to trend, relative to potential. So you can actually have growth in a depression, but the point is the growth is too weak. And so this is what we're in. We had... the third quarter, when you went down that sharply, you were going to come back pretty steeply. That's natural. But we didn't come all the way back. You know, people say, well, okay, you went down 31% and you went back up 33%. So aren't you back where you started? And of course, the answer is no, because you're applying the 33% to a smaller base. So if you normalize, let's say 2019 is 100% of 2019 output. You go down 5%, and then you go down 31%. Well, now you're around 65% of the prior output. Well, if 65 is the new base and you go up 33, that adds 21 or 22. But you're only back to 87 because you're working off a smaller base. Even if you have, in my example, 10% growth in the fourth quarter of 2020, it's 10% of 87, so add on 8 more. You're only back to 95. So a simple way to understand it, you fall into a 50-foot hole, you climb out 20 feet. Well, that's good climbing, but you're still in the hole. You're not back to where you started. But a better comparison is maybe Japan. I would say Japan has been in depression since 1990.
Yeah.
Now, it doesn't mean, now they had growth and recessions and growth and recessions. You can have 2 or more recessions in a depression with periodic growth. But the point is you never get back to the old potential. I mean, good example, the Japanese stock index, the Nikkei index, in New Year's Eve 1989, it was 40,000. Today, 30 years later, it's about 28,000. But okay, it came off the bottom, but it never made it back to the prior high.
It'll never be.
Oh, I think that's right. It may never be. And another example, in October 1929, the United States stock market crashed, a very famous crash,
Yeah.
but it lasted for 3 years. And when it bottomed in 1932, it was down 89.2%, almost 90%. That's what a stock market crash looks like. But then you ask people the next question and say, well, when did it get back to the 1929 high? How long did that take? The answer is 1954.
Yeah.
It took 25 years
Yeah.
to get back to where. Now, it doesn't mean you couldn't make money in the meantime. You could have bought the low in 1932 and made money in 1933. But that's what depressions look like. That's the kind of thing we're in. This will be intergenerational. The effects of this will last for not 30 months, but 30 years.
Wow.
And there's very good evidence to back that up. There was a group, it was an economist at the Federal Reserve Bank of San Francisco and two academic economists. And they looked at all of the pandemics in the last 650 years, going back to the Black Death. I often criticize economists because their time series are too short. They say they're doing correlations and regressions. I was like, well, no, you need a much bigger time series. Well, 650 years is good enough. But they went back to the 1350s, to the Black Death, and they looked at every pandemic in which 100,000 or more people died. The fatalities were 100,000 or more. Of course, the two worst were the Black Death, the plague in the 1350s, and the Spanish flu around 1918, 1919. The Black Death was about 75 million dead, they estimate, and the Spanish flu was 100 million dead. And then after that, there were several where there were 2 million fatalities and some fewer. They were using 100,000. Well, there were only 15 pandemics in the 650 years where 100,000 or more died. COVID-19, by the way, is going to end up being third on the list. Right now, it's fifth, but we have over 1.8 million fatalities, but it's not under control. So you can see that number is going to go past 2 million. It'll pass the Asian flu, and there was one other influenza in the late 19th century. So it's going to be third on the list. But what they asked themselves, because they're economists, not doctors, and they said, well, how long did it take these economies to normalize following these extreme pandemics? And the answer is, on average, 35 years, not 35 months. And just to kind of give a concrete example of that. So I grew up in the 1950s and 1960s. It was a very prosperous time in the United States. I did not live through the Great Depression, but my parents did. And my grandparents did. So I was raised with a sort of depression mentality, even though I didn't live through it. And when we were little kids, 9 years old, my parents would send us out. We'd take our wagons and go door to door and collect tin cans and newspapers. And we weren't doing it for environmental reasons. It might have been good for the environment, but we were doing it for recycling because all that stuff could be turned into buildings and so forth. And so, as I say, and that didn't change until the late 1960s when the baby boom came of age, and then we just started partying and using credit cards and everything else. So it did change, but it took 30 years to change. In other words, the behavioral and adaptive effects of the Depression of the 1930s lingered through the 1960s. And that's my experience, but it's consistent with what these researchers found out. But at the end, when we get to asset allocations, I said the first thing I do is I explain my methodology and explain what diversification is. Diversification is a very powerful tool. It does what it's supposed to do, which is increases your total return with less risk. But people don't understand how to diversify. I run into people, they say, well, I'm diversified. I own 30 different stocks in 10 different sectors, technology, consumer non-durables, minerals and mining, et cetera. And I say, you're not diversified. You may have 30 stocks, but you're in one asset class called stocks. So and stocks are hard, they'll go up together. I'm not saying they won't go, they'll go up together and go down together. So you may have 30 stocks, but you're not diversified. Diversification is, okay, have a slice for stocks, that's fine. Gold, cash, real estate, treasury notes, and alternatives. That is closer to real diversification. So in particular, I recommend about a 10% allocation to gold. And people always want to put words in your mouth. They say, well, Jim Rickards says sell everything and buy gold. I've never said that. I don't believe that. But a 10% allocation, I think, is right. That will, if there is extreme inflation, that will produce gains that are so large, they'll kind of insulate the rest of your portfolio. So you're protected that way. And if there's a loss of confidence in the dollar or some kind of currency collapse, again, gold will do very well. I also recommend 10-year treasury notes, or for the German investor, bunds, 10-year bunds, And the reason for that is, I mean, first of all, they're high credit, they're liquid, but interest rates are going to go lower, which produces capital gains. It's a little bit counterintuitive. People don't understand bond math,
Yep.
but it's pretty simple. If interest rates go down, the value goes up. So as interest rates go down, you're getting more capital gains. So we have a lot of, very smart, very prominent people in the United States, Jeff Gundlach, Bill Gross, Dan Isaacson at PIMCO, and others who say, the interest rates are too low. This is the greatest bond market bubble in history. Short the bond market, et cetera. One by one, they've been carried out feet first. They've been wrong about that. And the reason is they confuse real rates and nominal rates. So nominal rates, that's the rate you see on television or when you look at a screen. That's the nominal rate. But the real rate is the nominal rate minus inflation. And the problem is nominal rates are low. That's true, but real rates are not low. I borrowed money in 1980 at 13%. That was my first mortgage. My mother cried because her first mortgage was 2%. But I said, Mom, I'm borrowing at 13%, but inflation was 15%. So my real rate was -2. Plus taxes were 50%, 50, and my interest was tax deductible. So I got a tax benefit on the money I was paying of 50% on the 13%. So that's another 7%, 7.5%. So my after-tax rate, after inflation, after taxes, my real rate was -8. So I was borrowing at 13 nominally, but my real rate after taxes and inflation was -8. That's a low real rate. But the point is that that's where we have to get to. If you want to stimulate the economy and borrowing and lending and spending and investment, et cetera, you have to get real rates much lower than they are right now. Well, we're not getting inflation. Eventually we may, down the road we may, but not now. Deflation is a greater danger. So if inflation is declining, we're getting disinflation and deflation, and the nominal rate is here. How low does the nominal rate have to go to get to a negative real rate? Well, it's got to go negative. It's got to go maybe -2 or -3. That will produce enormous capital gains for the bondholders.
Kemana lah HP Mima itu hilang, ha? Hah? Gak tahu. Carilah HP-nya. Hilang-hilang terus loh. Tiranto hilang, ini hilang. Gimana Mima terakhir pakai HP-nya? Hah?
Nggak tahu. Lupa.
Mak, nggak dapat loh HP-nya ini loh, Mak. HP Bima itu nggak nampak tadi mana taruhnya. Bima apain HP-nya ini Bima? Ini kenapa bisa loading terus dia m-bankingnya? Kok nggak tahu Mima apain tadi malam ini? Nanti Mima apa nggak upgrade iOS gak?